Most people believe the next financial crash will look like 2008, a housing collapse, a stock market meltdown, banks failing. But that expectation is exactly what makes this crash so dangerous. This time, the problem is not real estate. It is not corporate debt. It is not the stock market. The real bubble is hiding somewhere far more dangerous, inside the money itself. When the thing you use to measure value becomes unstable, everything built on top of it becomes fragile. Your savings, your retirement, and even the cash in your wallet are exposed. This is why the coming crash will feel worse than 2008, even if asset prices do not collapse the way people expect. Understanding this shift is the difference between losing purchasing power and protecting it. If you want to protect your money before the system changes, hit like, subscribe, and comment crash below. Why everyone is fighting the last war. Most investors are preparing for the wrong crisis. They are waiting for another deflationary crash like 2008, where asset prices collapse and everything goes on sale. That kind of crash rewards people who sit in cash. But the world has changed. Central banks no longer allow the system to cleanse itself. Instead of letting prices fall, they inject money to keep things afloat. This creates inflation instead of deflation. That means asset prices do not crash, currencies do. People who wait in cash think they are being safe, but they are actually standing in the most dangerous place possible. The purchasing power of money is being slowly destroyed. The last crash reset prices. This one does not. It permanently shifts them higher, leaving those on the sidelines further behind every year. The reverse market crash. Since 2023, something strange has been happening. Instead of markets collapsing, hard assets have been exploding upward. Bitcoin, gold, and major stock indexes have all surged. Meanwhile, cash has quietly lost value. This is what is called a reverse market crash. Instead of assets falling, money falls. People feel poorer even though markets are rising. Your paycheck buys less. Your savings cover less. But asset owners get richer. This is not a coincidence. It is the result of massive money printing and debt expansion. When trillions of dollars are created, they must go somewhere. They go into assets. This is why those who stayed invested have grown wealth faster than those who waited. The crash is not happening in prices. It is happening in purchasing power. The real bubble is the dollar. Every crash starts with a bubble. Today, that bubble is not housing or tech stocks. It is the US dollar and government bonds. The government is borrowing trillions of dollars every year just to operate. The Federal Reserve is printing money to help fund that debt. This inflates the value of bonds and devalues the currency. When the foundation of the financial system becomes the bubble, everything on top becomes unstable. Stocks, pensions, and real estate depend on the dollar. When the dollar weakens, everything feels expensive. That is not because assets are overpriced. It is because money is losing value. This is why the coming crash feels invisible. It is happening slowly, quietly, and relentlessly inside the currency. Why big tech and crypto are rising, the surge in tech stocks, Bitcoin, and even NFTs looks irrational on the surface. But when money feels unsafe, people run toward anything that cannot be printed. Big tech companies hold massive cash flows. Bitcoin has fixed supply. Gold is scarce. Even digital collectibles represent something limited. These assets become shelters when currency weakens. This is why the largest tech companies now dominate stock market gains. Capital is fleeing cash and hiding in what feels safer. These are not bubbles in the traditional sense. They are signals. They show where money is going when people no longer trust the currency. Once you see this, market behavior suddenly makes sense. Why this crash is worse than 2008. In 2008, the system broke, but money survived. Homes collapsed. Banks failed. Stocks crashed. But the dollar still worked. That meant people who had cash could buy assets cheap and rebuild their wealth. This time, the problem is not the assets, it is the money itself. When currency loses value, there is no reset. Prices do not fall back to where you can afford them. They keep rising while your purchasing power keeps shrinking. Waiting in cash no longer gives you opportunity. It slowly destroys you. That is what makes this crash more dangerous. There is no sale coming. there is only erosion. And if you are not positioned correctly before it happens, the system does not give you another chance to catch up. How capital is quietly fleeing. Cash. We are already seeing signs of capital flight. Investors are pouring money into Bitcoin, gold, tech stocks, and scarce assets. These moves are not driven by hype. They are driven by fear of holding cash. On-chain data shows massive inflows into crypto. Gold continues to rise. Even speculative markets like NFTs attract money because people would rather hold something scarce than something that can be printed endlessly. This behavior mirrors historical periods of currency instability. When money feels unsafe, people will buy anything that looks permanent. These are not bubbles in isolation. They are symptoms of a deeper problem: loss of trust in fiat money. The winners of the reverse crash. The winners of this kind of crash are not the ones who hide. They are the ones who move early. Assets that cannot be printed become extremely valuable. Bitcoin, gold, prime real estate, productive businesses, and scarce collectibles all rise as money weakens. These assets absorb the inflation. Meanwhile, cash holders and bond investors fall behind. Fixed income cannot keep up with money printing. This is why traditional safe strategies fail. In an inflationary collapse, safety comes from scarcity. People who understand this do not wait for prices to fall. They move into assets before the currency falls further. Why diversification is not enough. Many people believe that spreading money across stocks, bonds, and cash makes them safe. That works in a deflationary world. It fails in an inflationary one. When money is being debased, everything tied to fiat loses purchasing power. Bonds fail, cash fails, even some stocks fail. Only real assets hold value. True protection comes from owning things that rise faster than inflation. That means owning scarce assets, not paper promises. Without this shift, even diversified portfolios quietly lose ground. Why waiting in cash is the real risk. Most people think holding cash is safe. In reality, it is the riskiest position in an inflationary collapse. Every new dollar printed makes the ones you already hold worth less. You don't see it on your bank balance, but you feel it at the grocery store, the gas pump, and in your rent. While you wait for a crash that never brings cheaper prices, assets quietly move higher and further out of reach. This is why so many people feel poorer, even though markets are rising. They are standing still while money loses value. Cash only protects you in deflation. In inflation, it guarantees you fall behind. How this becomes a once-in-a-generation opportunity. Every monetary collapse creates a massive transfer of wealth. The people who understand what is happening before everyone else have a chance to move into the right assets early. That is how fortunes are built. This is not about panic, it is about positioning. When currency weakens, real assets rise. When trust in money falls, scarcity becomes priceless. Those who move into Bitcoin, gold, productive businesses, and hard assets before the system fully shifts are the ones who emerge stronger. This is why this moment is not just dangerous, it is historic. If you want to protect and grow your wealth in the crash, most people don't even see coming. Subscribe, share this video with someone you care about, and comment below which asset you believe will survive the money collapse. Because in this new financial system, understanding scarcity is everything.